We have a number of distinguished guests on the call. So on the call, I've invited a residential agent from Zimbabwe, Leonita Mhishi. She runs a property practice called the House of Stone Property. And just to give a residential experience of what the mood is like, what investors are trying to do. We are post-elections in Zimbabwe. We've had some currency stability, relatively so, for the past 2 or 3 months. Leonita, could you just give us a bit of a walkthrough what's happening in the Zimbabwe property market?
All right. Hi, everyone. My name is Leonita Mhishi. I'm with House of Stone Properties, specializing in residential sales, buying, rentals, management, and development. Just in a nutshell, the Zimbabwean real estate market has seen a substantial growth in the residential sector, which is mostly driven by various demographics. We have the real estate market, which has buyers from different diverse backgrounds, from different levels of income as well. We're looking at, we've got different modes of payment of Zimbabwe as a cash economy. So obviously most sellers are looking for cash buyers. But of late, because of the government purchasing houses for civil servants, they've sort of diverged from accepting just cash only to accepting nostro payments. So we've got the local payments, which is the FCA, and mortgages as well. There's like a huge construction frenzy for gated communities as more and more buyers, especially young couples and retirees who are preferring the security and convenience of lock up and go. But that as may be, the supply is yet to meet the current demand. We also have a significant influence on the prices. This is now a buyer's market where the buyer has more power to negotiate prices and other terms, and specific needs, preferences of local buyers are important factors to consider when marketing properties. We've got the higher end market, which caters to a different set of needs and preferences than the lower end. The higher end, they're willing to pay a premium for features such as security, exclusivity, and comfort. Whilst the lower end, they tend to look for more affordable properties and flexible payments, such as serviced residential stands and properties with title deeds. We have seen a frenzy as well in developments of medium, low, and high density residential stands right across Zimbabwe. We've got the high density buyers that are looking for affordable housing options, therefore tend to buy houses in the lower price ranges. This includes farmers, young couples, miners, business executives. We've got a lot of miners, like gold miners now, who are on the market looking for properties to buy, which is a good thing. The other thing that's happening in Zimbabwe, we've got sellers. Like I said in the beginning, Zim is a cash economy. But this is due to the continuous currency depreciation and which the country is currently facing due to serious foreign currency shortages. But though sellers are asking for cash, they also have unrealistic listing prices. So some tend to keep properties on the market for long periods of time, which is a disadvantage, especially to the sellers. So pricing your property right will actually make the property sell faster. We've got price ranges for suburban properties, like for high density, the properties are going for between 17,000 to about 40,000. It has generally increased to probably 60,000. And the medium density is between 50 to 120, which has sort of in the last 2 weeks increased from about 50 to 60,000, and then 120 ranging to 130s, 140s. Then your low density suburbs, they're selling between 150,000 United States dollars right up to $1 million plus. We've got a property on the market which is going for $6 million, and we've got more in those price ranges. Those sounding crazy, but those are the prices for Zimbabwean houses. We've got economic factors that are affecting the real estate market. Current interest rate sits at 150%, which is hiking up borrowing costs. Another notable trend is that sellers often prefer US dollars, which also increases expenses for buyers. This, in terms of transfer costs, the transfer costs range between 9, maybe 8 and 9% of the selling price. So it also affects the buyers, especially if they don't cater in that when they're looking for a property. The surge in nostro payments, we also have companies that are buying for their employees using nostro payments. I think it's another topic for another day because it's a broad topic, so I won't go into that today. But we've got companies that are buying, we've got individuals that have nostro payments, and we've got sellers also that are accepting nostro payments. We've got banks that are offering mortgages, but mostly to their employees, which is then affecting the normal individual in the street. So it's the interest rates as well are very high. So people are not tend to go for the mortgages in Zimbabwe. Factors such as weak currency, high interest rates, depressed disposable income, unfavorable mortgage facilities, exchange rates, all those are affecting the prices in Zimbabwe. However, there's still hope for buyers in Zimbabwe real estate market. Firstly, you got to engage services of a well-informed and savvy negotiator who can make a significant difference in navigating the economic challenges, as well as expertise and in-depth knowledge of the local market dynamics. This is very valuable for both sellers and buyers. You have to engage a registered estate agent. Their support can make informed decisions and seize opportunities that align with your needs and your budget. This also increases the chances of you finding the right property. In conclusion, even though Zimbabwean property faces many challenges and the construction frenzy that is currently being faced in the country, it is quite clear that the demand for properties surely outweighs the supply. The government is also looking into giving land to developers so that to shorten the housing list as it is so long. And we appreciate the current disposition. And that is all from me for now. Thank you. Hello? Am I alone here? Hello?
No,
Hello?
you're not alone.
We can hear you.
Thank you. I thought I was alone.
No, you're not. Florence from Uganda. The issue I think we had, our moderator got off. So I think we shall do the running ourselves. I see after you, I'm supposed to be sharing. So I'll go right ahead unless we say otherwise. Fellow panelists, I don't know. What do you think?
No problem, Florence. You can go ahead. Just because it seems like Kura is having network problem.
Yes. Okay.
Yeah, sure.
I'm Florence. I'm a land surveyor. I'm also a real estate practitioner here in Uganda. I'm a lecturer at the university, Ndejje University. I teach land surveying students. I'm glad to be here. Good evening to you all. Yes, mine was to tell you about our tenure system here in Uganda. Our tenure system in Uganda can be divided into four. We have one, which is the customary ownership of land. We have the freehold ownership. We have leasehold. Then we also have Milo. I see some attendees from Uganda. Yes, hello to you, Mr. Chimera, especially, and to the rest of you. So with the one that is most common, or that the people know most about, is the Milo registration, the Milo tenure system. This is a word that came from the word mile, as you hear mile, a square mile. It came over through colonization, where the masters used to give out miles, square miles of land to the sympathizers, the people they worked with, the locals, and it was localized as Milo. So that is Milo tenure. So under this tenure, people own land in perpetuity. If you own it, your children, the grandchildren, they can all own the land. Then one special thing about this type of ownership, it puts into consideration the squatters. Squatters are like occupants on land, meaning here with this system, I, Florence, can own a title, but it can also have people occupying the land, owning what we call bibanja, ownership rights. Like they're the ones using the land, they're cultivating on the land, they're dealing with the land. But me, as the title holder, I have my title interest. And you'll find as you negotiate with the squatters or the tenants on the land, they can either pay a fee, we call busulu, which is like an annual fee, or you as the landlord, you can always subdivide and have them have their interests, their Milo interests, they can hold in perpetuity and give to their children. Then another that we have is a freehold tenure system. Under the freehold, still we have the titles being held in perpetuity. But this one, you will not be granted a freehold title if the squatters or the tenants on the land are not settled. Meaning if they're squatters, if they're occupants on the land, you'll not be given a title. So that is the freehold title. And similar to this Milo one that I mentioned first, you also hold the land in perpetuity. So we see this freehold title, which is given on what we call public land, land that was left to the government, like the Uganda government, as the colonialists left. This is where we get these freehold titles. Yes, then the third that we have is the leasehold. So for this land that was left by the colonialists, this one that was given to the sympathizers, leaseholds can be made. And a leasehold is for a given period of time. Of course, there is an agreement between the less they pay as ground rent, how much is to be paid as premium, the conditions of use. So that is the leasehold title. We have leases coming from 5 years to 99 years. Those are the long leases. Then something special, we also have institutions, like culture institutions, like Buganda Land Board. These ones hold the land of the kingdom. Then they give leases. They hold the Milo interest. Then they give the leases to the tenants, same as the government. The government also does that. It has its land, which is like public land, which would be the freehold. Then it can give out the leases to people. Then the last one that we have the customary tenure. People hold land according to the norms and traditions of a given community. We have this in parts of northern Uganda, where people hold land communally and they use it as families, and it's held in trust by the chiefs or the family leaders, the elders hold this land. So those are the 4 that we have here in Uganda, and that is how people own land. So those are the tenures. And with these, they actually give what you'd call deeds. We have a freehold title that can be given out. We have a leasehold title, a minor title, then customary certificates that show the ownership. Yes, so that is about our tenure system here in Uganda. We had issues, or we had people comparing, for example, the prices of our roads, prices of the roads in our neighboring country, like Kenya. And the difference came in with the fact that our tenure system is quite different, that land is owned by the people. Even when the government has to implement, say, a road, a school, a hospital, these people have to be compensated, even when it's compulsory acquisition, that yes, the government wants this place, it will use it, but they will have to give you money. So that is about the tenure systems that we have. Then our market here, the real estate market here in Uganda, is mainly, according to me, residential. I see more people going out of their way to buy pieces of land. Our standard is about, we have it in feet, 50 by 100 feet. That is the minimum that you can get a title for, regardless of the tenure or the type of title that you want to make. So we have 50 by 100. So we see the trend of people wanting to own land going up, mainly for residential. But even when it's commercial, we see people looking at building, let's say, apartments, building rentals, rental units, which is more so also residential. Yes, it's commercial, but ultimately it's used for what? Residential purposes. So that is the trend mainly. Then with the industrial, we are seeing industrial mainly by like bigger companies, by the government and bigger institutions, with less individuals doing land for industrial purposes. So the trend mainly is people having land divided for residential. Residential, like for them to sleep home, or residential commercially, for them to be able to get money out of it through the rent that is paid by the tenants. So that is about our market as here in Uganda. Then the players that we have in terms of financing these endeavors, financing the market, we have quite a number. Yes, people do with the bank loans, people do them. The mortgages are not so much. It's not something that is widely appreciated. People actually rather they get their loans, then they do their land purchase, not like the mortgage, like how we have it, that someone finances, the money gets done, and then they can have the house. No, though we have institutions still that are doing those. We have private institutions that are doing the mortgage kind of financing. Then also we have the government institutions that are doing that. And like I told you, we have the kingdom, for example, they have houses that are up for sale. People pay in that kind of arrangement. So mainly I would say people finance, yes, by themselves actually. People save their money, they do their financing for the what? For the market, to buy land, buy real estate, to buy property. People usually do that kind of financing. Then also something that I'm seeing in the latest trends is investment clubs. People are going out of their way to save money as a group, okay, to buy the land. We have what we have like Nigina is, it's a localized word where people get together, save for a given purpose. So we are having even land investment clubs coming up. People are saving their money over a given period of time and being able to do what? To finance their real estate. Then maybe something I should have mentioned also, our government is going out of their way to ensure that people are actually titling their land. Here in Uganda, titling is voluntary. If someone chooses to have a title or not, and if they don't have a title, they just own their land via a sales agreement. But the government is going out of its way, and they're having sensitizations. Actually, they're also doing what we call like systematic adjudication. They're surveying systematically so people can get their titles. Then they're also giving out titles to people in certain areas under a subsidized kind of system. So that is how our system is. Then also about the expectation of the capital value. Of course, as real estate is, the values are going up. The values keep going up with each passing day as development, of course, comes in. We are seeing roads, we are seeing infrastructure, hospitals, schools, and of course, people building. And as land is getting utilized, definitely the capital values are going up. And for us, our market, the real estate market, is actually looking very bright, with very many people getting interested in purchasing land, mainly for resale. People purchase land, they buy a big chunk, they subdivide, and they're able to sell it. That's what I can share for now. Thank you.
Thank you very, very much for that. If I understand, your communal land, you get certificates from the chief for your occupancy of the ground?
Customary land. We have a ministry of lands. We have a lands office that does all that. But with the different tenures, you get a different type of certificate. Like the rights are different based on the tenure of the land.
Excellent. What sort of acceptability for security purposes are those different titles? Do the banks see them all as equal and you can pledge it to get a mortgage?
Yes, you can place them to get a mortgage, but for example, depending on the duration. For Milo titles, these are very much accepted. Freehold, yes, because someone holds them in perpetuity. But usually for leaseholds, which have a given duration, say someone has a lease of 49 years and you just have a few years to go, the bank may step back a little when giving you certain amounts because they know the moment the lease expires, then that title will not be viable. But they give the monies on the titles.
All right. What sort of construction activity are you seeing? Are people demanding these more modern cluster or flat apartment type things? Are there malls coming up in Uganda? What's the in thing that side?
Now the in thing this side is actually building for rent. Like I say, people are looking at, yes, residential, but they're looking at residential where they can make some money out of their residential places. And we are having development, different development in different areas.
Thank you so much, Florence. I'll take any questions from the floor.
For example, we have areas that are closer to the city.
My signal was doing also well. Now it seems to have dropped off again. My apologies.
Hello.
Yes, yes, we can hear you.
Hello, I'm given an opportunity to talk.
Sure, you can. Sure.
Yeah, I'm called Kimera Peter from Uganda. Thank you very much for this educative and informative discussion this evening. Madam Naamboze, thank you very much. Madam Naamboze, I've been following you for quite a long period of time. You are an inspirational in the country. You are very much now known in the land systems of Uganda. Everywhere I think I can see you appearing everywhere now. So it's because of you that I'm joining this discussion this evening. Right now, I'm out of the country. I'm in South Africa, actually. I'd like to have some few comments. Let me start with Miss Leonita Mhishi, I think a discussant from Zimbabwe. Thank you very much for your submission. You can hear me, members? Can you hear me well?
Yes, we can.
Yes,
we can.
hearing you loud and clear.
Very loud and clear.
Leonita, your discussion was very marvelous. When it comes to the issue of banks giving or offering mortgages in Uganda, that scenario, that thing is almost not there. It's there, but to a less extent. Banks have got a very big problem in understanding the importance of recognizing people to pay in bits and in bits in order to finance some ventures in real estate, which is not the case, I think, in Zimbabwe and some countries like South Africa and some other countries like in Egypt. In Uganda, banks does not consider solemnly financing real estate developers. Most of the real estate developers, they use their money. They use their money to establish investments of that nature, which is a backlog to the development of the industry in the country. And in Uganda, real estate is growing very fast. People invested billions and billions of dollars because the market is huge in Uganda. And I think in Africa, including in South Africa, Uganda can even beat South Africa in real estate when you analyze it critically. But on the surface, you can see South Africa is growing fast. You can see Namibia is growing fast. But Uganda, the nature of the economy is a bit different from the so-called countries which seems to develop like South Africa, like even Egypt, a very big economy. But the nature of real estate is confusing. But in Uganda, real estate is booming. But the problem, money to be disposed of by financial institutions to real estate developers. Also, Leonita talks about high interest rate, still a problem almost everywhere because of the depression in world economies. We have a problem also of engaging registered estate agents. That is a big challenge in almost everywhere. But in Uganda is worse. Real estate developers in Uganda are not professional. Madam Naamboze, you can bear with me. Almost 95% are not professional, but they are making money. For the sense of making money, they are making money, but they are not professional. I think there's a need for the industry to be regulated in order for people to operate in an environment which favors the stakeholders. Also, there is the issue of cash economy. Uganda is the same as Zimbabwe. Money is everywhere. People are moving with sacks of money in the streets. So anytime somebody can purchase a property, even if during midnight, people buy properties and make money the following day. So still the nature of the economy is almost the same. Unlike countries like South Africa, Namibia, Zimbabwe, I think is the same issue. Though I sense some kind of professionalism in Zimbabwe. That is Madame Leonita's submission. So going to Madame Naamboze Florence, a qualified and a professional land surveyor and a lecturer at the same time. Yeah, also the land system in Uganda, the tenure system, favors very much real estate developers. There is no too much complexity. There's not too much hardship in acquiring land in Uganda. So to acquire land in Uganda is very simple to both the inmates, the indigenous people, the foreign investors. You can own your land in Uganda without too much restrictions. There is some restrictions as laid down by the law, but still you penetrate them legally and you acquire land and you start making money. So somebody who want to develop or not to inject money in real estate, I think Uganda is a good place to make money. And I've seen so many people, even there's people from Zimbabwe, they started investing in real estate in Uganda. And the money comes very fast in Uganda than in South Africa even, and some other countries which seems to be developed. So thank you very much. Sorry.
Thank you. I would love to put that to the test. I did hear money comes fast. My ears pricked up, and I'd love to put that to the test. I'm running under a bit of a time pressure here. One of our speakers, Kundayi Munzara from Sesfikile Capital, he is a director and shareholder there. He looks at international markets, the REIT listed sector, South Africa in particular, and then a global fund. So he's under some time pressure. So I appreciate the comments that have come from the heart of East Africa there. But can I give the microphone over to Kundayi Munzara to take us through the listed property trends that he's seeing. Kundayi?
Kura, I'm just going to share my presentation. I'm just checking that you can see it right now.
Yes, I have visuals. Thank you, sir.
Okay, good. Well, I'll try and improve those visuals to a full screen mode. And tell me, please, if you can see it as well. I'm just going to reveal my face to show that there's no bot behind this, as we're seeing in the age of AI. But it was... I was listening in on the discussion about everything happening in Uganda, and to be honest, my knowledge of Uganda is quite limited, so it was interesting to hear. Am I allowed to go ahead with my section of the presentation, Kura?
Yes, please go ahead, sir.
Okay, fine. Okay, guys, thank you for dialing in those that I have. And I just got a message from my friend who just landed in Harare now from Nairobi and was kind of made sure they dialed into this discussion. So, you know, all the views, I think, from the other panelists or from all the questions from the audience are obviously valuable to people to almost want to kind of navigate around their timetable. But I will be about 25 minutes, and what I'll do really, my focus maybe is at a slightly higher level, but higher level, I don't mean superior level. I just mean a little bit removed from the day-to-day happenings on the grounds per se. And what I'm going to do is touch on various markets, particularly South Africa, and then I'll go straight to the global developed markets, focusing on what's happening in the property sector in the different jurisdictions. Now, to just start off my presentation and just give you a bit of an overview, Sesfikile Capital is a business. I'm a co-founder, one of 3 co-founders of Sesfikile Capital. We started the business in December 2010, so we are close to 13 years old now. We got a singular focus in investing in listed property funds on behalf of pension fund clients and multi-managers and individual investors. And you could say 99% of our investors are South African investors. So we are based in Johannesburg and we invest for South African clients, both in our 2 strategies, which is local in this case, I mean South African, listed property and global listed property. For those people on the call who are quite close to the property sector, some may not be as familiar with the listed property sector. And by listed property, what I'm talking about is companies that are on exchanges like the Johannesburg Stock Exchange, like the New York Stock Exchange, like the London Stock Exchange, that invest in property assets. And the bulk of the earnings that these companies deliver comes from rental income, as opposed to profits on development of property. So broadly speaking, we call them REITs, which are real estate investment trusts. And please forgive me for those that know this terminology very well, but I find that, just for completeness, it's good to mention. In terms of assets under management, this is not our assets, but these are our client assets. We manage around 15 billion Rand. So if you were to look at today's exchange rate, is probably just under $800 million on behalf of clients. As I said, be in both the local South African and global property markets, and are important to our clients and our perspectives. We've delivered top quartile performance over the long term relative to our peers, with around 14 years average experience in our investment team. So now just bouncing straight to the market and where things now. The last time I was on this in this session or presented was 20 July 2023, is that what we're seeing is that property in general, global property and local property, has both lagged the general equities. If you look at general equities, that general equities this year are up about 12% in dollars. US equities, as denoted by the S&P 500, up about 14% in dollars. Then you look at global property is down 3.71 US dollars. And then our domestic, meaning South African assets, down 6% if you look at general equities, and South African property is down about 12% in dollars. This in no way is got any real link with what's happening in the direct property market. So if one was to look at direct property, it's actually a story of a slow recovery, and things are getting slowly better, but every month seems better than the previous month from a recovery perspective, especially if we look at where we are now relative to the, call it the depths of COVID, when shopping malls were closed, or people were almost forced to work from home or stay at home in the extreme case. So, but broadly speaking, we've seen property lag general equities, and there are a couple of reasons for this. I think the next one is probably the biggest story and maybe the biggest update, because what we've seen, if we look over the last 18 months, maybe a little bit less than that, is that central banks globally, if we look at 2021, inflation in the US, in South Africa, in the UK, and in Europe was very low. So in the US, you probably had inflation in between 1% and 2%, same as Europe, same as the UK. However, from about Q1 of 2022, what we saw is a massive acceleration in inflation. And what happened as well in February last year, if you guys recall, a totally unexpected surprise, unexpected occurrence was the Russia-Ukraine war, which caused massive imbalances in terms of energy prices, particularly for Europe, obviously impacting and food prices as well. As many of you know, Russia and Ukraine are some of the biggest wheat producers and refined oil producers globally. So anytime you've got disruptions in some of those commodities, those things tend to be inflationary. So what we saw from last year is that in reaction to inflation rising was central banks started hiking rates very aggressively. Many of us, in South Africa with a mortgage, every single month, we've looked at it with bated breath and said, shucks, are they going to inflict more pain on us again? And they did. And in fact, the South African Reserve Bank was a bit earlier than the other central banks and started hiking as far back as November 2021, which was a full 3 or 4 months before the other central banks like the US started hiking. So I think we should give credit when credit is due that Lesesha Kanyako was way ahead of a lot of these central bankers in the developed economies in terms of handling inflation, reacting to inflation and foreseeing the pain that was going to cause on the broader economy. Just because it's West, it doesn't mean it's best. And we've seen something, maybe something to actually celebrate in terms of South African Central Bank do a great job. So if you look at where we are now, fast forward to September, or most recently, August 2023, is that the Fed, which is the US Central Bank, recently, actually last week, had a speech where they make a call in terms of the committee makes a call on central bank on interest rates. And in that speech, they decided not to hike interest rates. However, what they reiterated was that the 2% inflation target remained. US inflation is just above 4% at this point, so it's about 2 times the target. But what is important is that what they did say is that they were willing to hike should inflation come back up. In addition, what they expected was that the US economy was running still quite strong and could avert a recession in 2024. The European Central Bank hiked interest rates, so they hiked their interest rates by 0.25%, so 25 basis points. However, they are unlikely to keep increasing those rates because they are worried about the general European economy, expecting a possible recession in Europe in the coming year. In the UK, which is the Bank of England, inflation also running at about 2 to 2.5 times the 2% target. They did similar to what the Fed in the US did by avoiding a rate hike, but are worried that a recession is on the cards. So they're probably done with interest rate hiking. And I think lastly, I'll say it again, the South African Reserve Bank inflation is now at about 4.7%. I think that's the latest reading. Their target is 3 to 6% band, and we're back in that band where it had gone outside that band, running ahead of 6% for a few quarters over the last 12 months. But obviously, and I think many of us who live in South Africa are worried that we are in a fragile economy that has high unemployment. We've had serious power outage issues, and obviously that has an impact on the economy. And we've got a looming election next year, probably April or May, and there are some people worried that that could be a further knock in business and consumer confidence. But broadly speaking, I think the point that I want to say is that central banks are probably near the end of hiking interest rates, but they will keep those interest rates high for a very long time. And I think a lot of people have probably thought that central banks are going to hike very quickly and then cut very quickly. And I think a lot of those thoughts should probably go out of their heads, and that we should be prepared for a sustained period of 12 to 18 months, maybe longer, where interest rates may not stay at the same level, but relative to where we were in 2021 and before that, are going to be quite high for quite a long time. And obviously that has implications for the real estate market, which is very sensitive to interest rates. Now, if I just jump over to the South African property market, this is a bit of an update, and many of us who are property investors will know that, giving a 3-month update on a property sector probably will sound a lot like repetition, because things don't, change that quickly. And what I'll do is I'll just touch on a little bit on the South African listed property market, not the entire property market. That listed property market has about 21 investable companies, market cap of the sector about 394 billion rand, so call it $20 billion. And about 29% of that is pure offshore, meaning listed in South Africa, but the actual assets or the companies actually operate in Central and Eastern Europe, largely Romania, Poland, some UK, and some Australia, US, and Western Europe, with the balance being pure in South Africa. In terms of sector exposure, 63% of that exposure is the retail sector. So a lot of the time when we're talking about South African commercial property, we're actually talking about what's happening in the retail sector. The office sector grabs a lot of headlines, and I'll speak about this in the global section. However, it's only 15% of the total exposure in South Africa, with about 16% being in the industrial sector. And by industrial, we're not talking about manufacturing. We're really talking about those big sheds that you see, which are distribution centers. So a lot of those sheds have flat, very flat floors, high eaves, and they store goods through a lot of racking, as opposed to manufacturing plants. So even if the manufacturing sector in South Africa suffers, and I'm not sure what the current state of it, in fact, we're actually starting to see some improvement driven by offshoring, that typically has no bearing on the industrial property space, because that is much more linked to the retail sector as it talks to the distribution and movement of goods. So it's pretty much where your pair of Nike trainers ends up before it comes to the store or comes to you directly if you're shopping online. So that's a picture of the sector at this point. And just, to recap on some things that I spoke about in July, but I think are still true, and we wanted to give you a bit of an update, is that vacancies continue to go down. So South African retail in general has a vacancy rate in the listed property sector of about 3.3%. In addition to that, if you look at the overall retail picture, the retail sector has probably got a vacancy rate of about 5.5% to 6%. So actually good conditions. And I think a lot of things have happened is that over the last 4 or 5 years, we have not seen many new shopping centers be built, or certainly not the large ones. However, what we've seen is that a lot of the retailers who spent many years between, let's say, 2017 and 2021, focusing on their efforts on expanding in offshore markets like the UK and Australia, a lot of them got burnt in these markets. And what they did is said, we're going to refocus on our domestic market and we're going to grow our store footprint here. So if you've got a situation where not too many shopping centers are being built, but the retailers are expanding, you start to see that compression in vacancy rates or lower vacancy rates. In addition to that, something that we look at all the time is the gross rent to sales ratio. So think of it, if you're a tenant and your rent as a percentage of your sales fall, it means that either your rental absolute number has gone down or your sales are doing better in store. And it's the latter which has happened over the last couple of years, which has pushed that rent sales to ratio to about 7%, a number we last saw between 2013 and 2014. So the South African retail property market is actually in a good space. Despite all the headwinds, despite high inflation, despite high unemployment, despite all the concerns and all the kind of bad headlines that you hear about the country, the retail sector continues to show resilience and continues to do well. And it's driven by the retailers themselves that continue to want to grow stores. So Pick n Pay has got a big expansion drive through Boxer stores, which is their kind of lower income product. ShopRite continues to expand on the food space. TFG, which is the Foschini Group, continues to grow in terms of fashion retail and introducing new brands. And what we are seeing is that all of these guys are coming up with new concepts, reinvesting in their stores, investing more in growing their footprint and their online capability, which is helping the retail sector in aggregate. Now, moving on to something which is front of mind, obviously, I think every one of us who lives in South Africa uses that app, that ESP app that tells you when your load shedding schedule is going to happen. I certainly look at it on a daily basis. And I think what we need to make sure we keep on top of is the impact of load shedding on tenant operations or running costs. The issue is that a lot of tenants, particularly in the retail sector, have needed to pay extra in terms of diesel costs to keep the generators running, which has had an impact on their operations. So not a good picture. However, where I am a little bit positive is that a lot of the listed property companies have started to invest in solar solutions. So if you see the picture that shows Mall of Africa in Midrand, and the top of the center shows all those solar panels, meaning a lot of the center can actually run on renewable energy, which has a good impact or positive impact on the costs, operating costs for the tenants. However, what we cannot, what we can't underestimate is that electricity as a percentage of the total occupation cost is about 14%, and that number continues to grow in double digits, which means that for any retailer or any landlord, there's continuous margin squeeze because the costs are escalating faster than the lease escalations, which is something to be aware of. Now, moving on to the office sector, office is under pressure, but starting to see a bottom. And I think, we cannot mask the pressure in the office sector. However, the overall vacancy rate in the office space in South Africa is about 16%. What we are seeing is what we are calling a flight to quality. And what I mean by that is that there are different grades of property from P, which is prime, A grade, B grade, C grade, and sometimes you get D grade. What we are seeing is that the A, B, and C is seeing vacancies either stay flat or go higher, particularly in the B grade. But the prime grade, which is the best quality office space, the office space that has all the bells and whistles in terms of ESG, amenities, backup power, green energy, all of these factors, is seeing vacancies compress. 3 years ago, it was at 13%. Now it's at 9.2%. And in places like Cape Town, what we've seen is that that number is closer to about 7% in some markets and maybe 2% in areas like the southern suburbs. What we've seen as well in South Africa is something that's called BPO, and that's called business process outsourcing. It started at a kind of primary level of call centers, but is moving to other functions such as accounting or other back office support systems that are being outsourced by international companies into South Africa. And that is creating a new layer of demand that started in Cape Town, but is starting to move into Johannesburg, Pretoria, and in some very small parts in Durban. And this is helping the office space to a small extent, really just to keep vacancies where they are. Something that we get often is a question around conversions from office to residential. It does happen. However, it grabs more headlines than what the substance is. So it's actually a very small amount and it's at the margin. And if you think of it, it's quite difficult or costly to convert an office building into a residential building, just in terms of the plumbing, the space layout, and all of that stuff. It's not that cheap to do. In addition to that, in cities like Johannesburg and in some parts of Cape Town, especially the micro apartment Atlantic Seaboard area, there is a bit of an oversupply. So you probably shouldn't be seeing too much more residential being built in these cities. Now, moving to industrial, which I speak about when I talk about warehousing, again, vacancies continue to compress, and this is being driven by three factors, which I'll touch on, and I touched on in the last time I presented here in this session. there's a couple of things that are driving. One is supply chain modernization. So what is happening is that what is called the 3PLs, which is a third-party logistics operators, think of DHL, RTT, or some of these players globally. These are the third-party logistics operators. And what these guys need is to be able to compete effectively. They need to make sure that their warehouses that they operate out of are very efficient. And to be very efficient, you typically have to move into the most modern warehouses with the flat floors, eaves, stacked all the way high so that you can, compress or put as many products in there to be as efficient as possible. What we've seen is that as they compete, they want to move into modern warehouses. That's one aspect. Another is e-commerce. And e-commerce, although only at about 4.8% in South Africa, if you look at it in the cities, Cape Town, Johannesburg, Durban, it's in the double digits by my estimates, and probably is growing at a rapid pace. If you just look at the numbers that Takealot is showing, or what the likes of TFG is showing in terms of the e-commerce growth, or e-commerce sales as a percentage of total sales. That's another driver that is driving the logistics space. And lastly is something that we call onshoring. So onshoring came about because of COVID. And what happened is that as China was opening and closing, we saw a lot of supply chain bottlenecks. Some of us remember when it was starting to take 2 to 3 weeks, then suddenly it was taking a month or more to get a product because things were being stuck in different parts of the world. And what that prompted was onshoring, which means that some logistics operators or warehouse operators are saying, we want to stock more product at a time, or parts of the manufacturing process will do domestically in our home turf to make sure that we can always meet the customer needs. And that's driving more demand for warehouse space in a South African context. Something true to listed property is just something about balance sheets. Balance sheet risk has subsided significantly. A key measure that we use is called LTV, so loan to value. So think of the debt on a company divided by the value of the portfolio. So debt over assets is about 37% at the listed property space, but it had gone in 2020 during the height of COVID as high as 43%. So that got a lot of the markets a little bit worried, and we are in a much more comfortable position at this point. However, what I do want to caution is that as a lot of this debt is expiring, the banks are willing to refinance this debt. However, the cost of that refinancing has gone up significantly by as much as 2% and sometimes 2.5%. And what that means is that your earnings growth in the property space in South Africa is not looking good. It could actually be negative by as much as 2 to 4, maybe 2 to 6% over the next 12 to 18 months, because although the top line is growing, although the vacancies are compressing, what we are seeing is that the cost to refinance debt is impacting the numbers that the companies can see. Now, just going to where we are in valuations terms, the listed property sector in South Africa shows an 11% dividend yield or distributable income yield with a 9% dividend yield. So the 9 is what they're distributing as dividends. The 11 is what they can distribute. And what the companies are doing is that they're holding back a little bit by dropping their payout ratios to about 82% in order to make sure that their balance sheets stay sustainable. We actually support this because what you don't want is a company paying out all its earnings, and then when it's time to actually fix up their business, their buildings, or make sure that the buildings are right for the tenants, they always have to borrow in the capital markets, which is a previous, exercise or previous practice, but has now effectively remains almost at the margin and is not the mainstream. So 11% distributable income, 9% dividend yield. The sector trades at a discount to NAV of 37%. And a lot of people will ask, NAV is net asset value. And people will ask, is the V, which is the valuation in NAV, correct? We think it's correct because the sector has sold well over 14 billion Rand in assets over the last 2.5 years. And a lot of that was done at around book value, and in many cases at about 1 to 2% premium to book, which means that those values are defendable. So the 37% discount to NAV just feels a little bit overdone in terms of the sector looking cheap. Putting those things together, in the local context, we expect total returns of about 14% in rands over the next 2 to 3 years on a per annum basis. Our expectation is that our South African government bonds are way too high and are pricing in a little bit too much risk of the country relative to actual risk in the country. And I think over the next couple of months, we probably will see this risk subside, barring some concerns that people have around, the election, which I really don't have any major views on. Now, moving to the global property sector, before I start to take a few questions, if there are any, is the global property sector gives you a low-cost liquid option to invest in global developed market real estate. So when I talk about global property in this case, I want to underline the word developed market real estate because we're talking about 66% US exposure. Canada is about 3%, so you could call it 69 to 70% North America. Japan is about 7%, quite a big region. Europe, UK is about 14%, and then you've got Singapore, Australia, and Hong Kong forming the balance between 3 to 4%. So it's a story of choice and specialization. You've got 8 different countries or regions to choose from, so much more currency diversification. Where it really gets exciting is that you've got high level of sector specialization plus many sectors to choose from. So in South Africa, I really spoke about 3 different sectors: office, retail, and industrial. And if you remember the pie charts, those 3 sectors are 90+% of the total exposure. So that's really what we're talking about. But we're talking in the global property space, we're talking industrial housing, and then within housing, there's apartments, there's standalone homes, there's manufactured homes, and many things in between. We've got offices, we've got diversifieds, we've got retail, healthcare, data centers, all of this AI that we've been talking about and seeing in the headlines is popping up in the demand for data centers. And some of these data center companies are up some 30% in dollars this year. Really, what's great about the offshore developed market space is that you can look at a theme that's happening globally and you can find a stock that can benefit from that theme, or you can avoid a stock that we think will be disrupted by that theme, which is what our strategy is. It's our concentrated thematic approach. Just to touch a little bit on offices, I want to make sure this is a slide that I had the last time, it's the exact same slide. And it's really to say that, a lot of the time when you talk about global property, when you talk about commercial property, people almost get caught up in one part of the market, which is not the whole market. So whenever you search what's happening in global property, a lot of the time you're going to see feedback that tells you that things are bad in offices. And things are bad in offices. Vacancies, global vacancies, US are about 21%. UK now close to 12 to 13%, Hong Kong pretty high, Australia also high vacancies and high incentives because work from home has continued to erode that market. The economies have, even though they've been resilient, a lot of the job losses have been in the tech sector this year, which was the big driver for office demand over the last decade. So offices aren't great. However, offices only consist 9% of the see-through exposure, which means that, yes, they grab 90% of the headlines, but they're only 9% of the see-through exposure. As I said, you've got many other sectors that you can choose from, like self-storage, healthcare, data centers, to invest in and completely avoid the office sector. What I want to talk about, which is actually really exciting, is what we call the single-family residential sector, one of the big sectors in the US. And just what I'm talking about is standalone homes for rent. So think of, a lot of people who are property investors will either buy apartments or they buy a home that they can rent to third parties. So this is SFR, which is single family residential. And in the US, it's really a story of demographics. So just to put some numbers to it, there are about 131 million households in the US. about 66% of those homes are owned. So home ownership rates in the US is about 66% and about 34% are rented. So we're talking about that part of the market where people rent homes. Of those, that's 45 million homes. And of those 45 million homes, there are about 16 million homes that are single family homes. So single family homes, standalone homes with a yard and all of that stuff is about 16 million homes. What is exciting from an institutionalization perspective and what is exciting for us from a property investor perspective is that only 300,000 homes are owned by institutions, which are real estate investment trusts or private equity groups, which means that the road to institutionalizing this sector is long and it's going to be exciting. So of the 15.7 of the 16 million homes, 15.7 million are owned by non-professional investors. So think of, you know, someone who lives next door to you has another home in another part of the city that they rent out. We wouldn't consider them an institutional investor, although they are an investor. So we kind of call them a mom and pop investor, or more like an individual investor. They don't have the big systems or teams and all of that stuff running this stuff, which affects their margin over time. Now, the story is not only about the opportunity to buy into these homes and institutionalize them, but it's also a story of demographics. Now, what I'm talking about here is that in the US, the biggest age group or big age cohort is what I call the millennials. And the millennials are people between 20 and about 39, or between 20 and 30 and 40 at this point. And the older millennials are the ones that are moving from apartments into single family homes. So think of someone in their 20s probably is going to live in an apartment. But when they get to about 29, 30, they get married, they start a family, and what they want to do is move into a home. So that's that big demand that we're seeing being driven by the millennials, and the older millennials is that cohort that is renting homes. And a lot of them, which I guess I'm part of, are called the renter generation. So they want to own a home, but they don't have to own a home. They will delay that decision. They get married later. They have children later. So that kind of call to own a home and settle down is delayed by a few years, and they tend to rent. What is also exciting is that as we've seen mortgage rates go up, so the US, a 30-year mortgage in the US now is at 7.55%, when 2 years ago it was well below 3%. So the cost to own a home, if you get a mortgage, is much more than the cost to rent a home. On average, a lot of surveys show that on a month-to-month basis, the cost to rent is about $1,000 cheaper on average in the US, which is a big number, considering that people have experienced, you know, a big number in inflation, which has been eroding their disposable income. Another thing to point out is that the US house prices have started to recover. They started falling in about a year ago and troughed in about April this year, but have since started to recover again. So that cost to own a home has become again prohibitive for the average consumer in the US, simply because inflation has really been eroding their purchasing power. Now, another theme that I would like to talk about a little bit that's exciting for us is what's called senior housing. So this is when the baby boomer generation, people who are 70 to 85 years old, or the 80 plus population, continues to grow rapidly. So that's the second biggest population group in the US. I spoke about the millennials. The baby boomers is the second biggest population cohort. And that group is expected, due to increases in life expectancy, to grow by about 45% over the next couple of years in aggregate. What we are seeing is that supply in this space has dropped off by a big margin, by about 70 to 80%, which is massive. So what we're seeing is that the demand is coming, but the supply is not there. And the cost of money being so high has meant that developers are finding it less feasible to grow, to add new stock. And anyone who's an investor knows that supply often spoils the party. So if supply is falling, the party may continue. We like the single families, we like the senior housing sector. Now, just to close off and talk a little bit about valuations, we're seeing the listed property sector globally as showing good value, meaning that the multiples on the sector are looking cheap relative to equities, which means the sector is looking cheaper than it historically has traded relative to equities. It also shows a dividend yield in US dollars of about 4.5%. Think of what you get out of global bonds at about 4% at this point, 3.5% to 4%. Global equities at about 2%, and the S&P 500, which is the US index, at about 1.5%. So for the dividend investors, global property, is your friend. If we look at the price to NAV, it's about 17% discount, which means that we think the sector is relatively cheap as well, because a lot of the values fell in the last 6 to 7 months, but have kind of reached the bottom, and we don't think values are going to fall dramatically more, except in some parts like Europe or general office. We think values still have quite a bit to fall further. In some cases, as much as 25% in some submarkets. If we look at global property earnings, vacancies are about 5.3%. Global property saw a low. And we also expect earnings growth of about 5.5%, which is quite good. Japan looking good at about 10%. US at about 6.3%. Germany looking really bad at -7%. And that is really the residential sector. Really because they are refinancing debt much higher than what they were doing before. And other parts like the UK showing some 4.7%, which is not bad. Looking at balance sheets, I spoke about that number, that debt to assets or LTV used to be at about 46% before the financial crisis of 2008, currently at about 33%. So actually not a bad story, and refinancing risk is not a big challenge. In Europe, where there is a bit more leverage, we think this is a bit of a problem, and some markets, some property companies may have to do rights issues or may face bankruptcy over the next 12 to 18 months if they do not refinance, if the banks aren't willing to refinance their loans. What I spoke about before was central banks. Central banks are close to pausing on hikes or close to the end of hikes. What we found, and it's a study that was done by one of our international peers called Cohen and Steers, is that dating back to 1994 and looking at different periods when central banks hiked rates and stopped hiking rates, US REITs, which is 70% of the story really when we're talking about REITs, generally have outperformed from that point where you've got, where they get to pause in all those periods by an average of 8%. So it's a good time to look at potentially investing in global property, especially relative to equities. Equities have done well. They've had their party. However, we think REITs are looking quite attractive at this point. Putting those things together, we expect, the sector shows a dividend yield I spoke about of about 4.5%, dividend growth about 5.3 or 5%. The number falls over the next 2 to 3 years, and that's because the cost of refinancing debt continues to rise, and it will impact earnings. However, putting those things together, we expect total returns of about 15% in US dollars out of global property. Now, to close off, thank you very much, and I'll take any questions that may be.
I'm not going to be sure if you're going to need any questions, because in my ears, it's just ringing 15% in dollars going forward. I can't get that on a fixed deposit in Rand in SA, or I battle to think of another instrument that is easily accessible to me. I've got a question. When I'm looking for this international REIT uptake exposure, do I go through South African counters? I believe about 43% of our earnings within the South African REITs are coming from offshore. Can I look at it as buying in through SA on a weaker currency and then getting my earnings in a higher currency? Or should I look to be going directly into a property fund, a REIT, a global REIT through an outfit like yours?
I would say the latter, meaning so that's the 43% odd that you get through a South African REIT, as I said, is 23% of that 43 is in Eastern Europe. And I've been to Eastern Europe enough times to know that is not they're generally not developed markets at this stage. Not yet. They're doing very well. They're growing very fast, but they're not developed markets. So diversifying from South Africa to Eastern Europe, in my view, is going from emerging market to emerging market. So it's probably not the exposure that you're looking for if you're looking for a bit of diversity. In addition, the choices that are there on the JSE are not the best choices. So if you look at what we hold in our global property fund versus what we hold in our local property fund, even if we hold stocks that have offshore earnings, we would not hold some of those companies in our offshore fund that we find listed domestically. So you don't get the best choice. So the answer really is that you should look for a provider. We're a provider. We've got a fund that you can invest in, but there are other options. There are other competitors. We've got a great competitor called Catalyst. There are other different competitors that one should look at. In addition, one can actually invest in exchange-traded funds. If one goes on to Satrix or goes on to Core Shares, which is 10x, you can find exchange-traded funds that can give you that exposure. So if you've got your rand, a weaker currency, and you buy that exposure via an ETF, you can get that exposure. I would prefer if you invest via Sesfikile Capital, but it's not an exclusive option.
No, appreciate that. Any other questions from the floor? Kundayi, as usual, you've raised the bar and given us much to think about. Thank you for the number heavy. It makes us analyze, and I think it only gets better when we consider our own domestic situation. As you know, Zimbabwe has just begun the REIT conversation and moving forward, but then we need to benchmark ourselves against where we can be going. And this level of transparency and detail and what analysts look at is encouraging for us. Thank you very much.
No worries. I just want to reiterate, I do think that, in South Africa, staying here, operating here, I think people get caught up in the negativity. And I don't want to be insensitive to some of the negative things that are happening. However, in the property space, as I said, the retail sector, 3% vacancies is globally one of the best markets. Industrial sector has lagged what has happened globally in the UK and the US, but it's playing a big catch-up role, which I think we shouldn't ignore. So generally speaking, I think people tend to be over negative, and I think there's great opportunity in the South African, domestic property space, because I think the lack of confidence, the high interest rates has meant that people can't supply the market, or developers can't keep developing at the same rate they used to. But domestic demand has stayed kind of flat, which means that flat demand, falling supply means that actual earnings start to look a lot better in terms of the operational performance. I just want to reiterate that.
No, I appreciate that, and thank you for your insights.
All right. Okay, right. Cheers, guys.
Cheers. So we've been to Zimbabwe, we've gone up to Uganda. I'm going to want us to go from where we are, Johannesburg, to a bit north and a bit west. The Namibian team. Fransisco, do I have you on the line?
Yes.
Welcome to you, my brother. Welcome to you. You are our first Namibian participant on this platform. So it's a big, warm welcome to you.
Yes. Thank you. Thank you very much for the opportunity. And I just want to give a comment to Kundayi's. It's really a mouthful from your previous presentation. Guys, just maybe a bit of a background from my side. My background is in architecture, town planning, and property studies. I'm running a business very much focused on research That is basically where my interest is, and I'm currently doing some policies for the government, the rent control and the urban land policy. In terms of to provide perspective on the property market, I'll use it from the policy perspective and how basically it influences our market and different aspects in the industry. Now, to give a perspective from a post-independence, we are now 34 years independent country thus far. In those 34 years, as a country, we managed to produce 164,000 land portions, meaning across all the sectors, residential, business, retail, and so forth. So, which means that, and we are currently sitting with a backlog of around about 500,000 residential units. And for us to address basically that backlog, it will give us around about, basically it will then basically take us around about 65 years to be able to address the current backlog. So, and just maybe a bit of clarity. Kura, my name is Fransisco Neshila. Perhaps just for perspective, I see you're a bit confused. So that is basically what we're currently having. And in terms of the property the hot properties in Namibia, basically our hot properties is in different sector, which is on the coastal side. On the coastal side, basically we are looking at rental properties that are really picking up on a very, very fast pace. While in the central side of the country, which is basically Windhoek, the hot property market is more your student accommodation. We are actually in the first generation of student accommodation investments that is happening in the country, and a lot of institutional investors are looking into that space to be able to accommodate that sector. However, within the proximities of the major universities, there are also policies taking place where people can change their residential houses into student accommodation. So we also have a lot of individual investments that are doing those small stake investment in the country. And our property market per se in general, it's more based on mortgage basis, which is very much bank finance. I'll put it probably at 80% of that aspect. However, when it comes now to our residential market, where we're then having to assess the medium house prices, we are running at an average of 1.2 million, which is in South African rands. That is our average house price, which is quite very, very high in the region. I think we are probably within the top 5 on the continent in terms of the average house prices. And affordability is quite a very, very big crisis in the country. But hopefully we are able to address it in years to come, because the government is putting in some new policies in place. With relative to our investments to South Africa, we do receive a lot of capital from South Africa, especially in the retail market, because our retail market is very predominantly South African company. And a lot of aspects and a lot of experts are coming from South Africa, and they somehow tend to finance our property market in various sectors. And then most of our banks, the decisions are actually also made from basically made from South Africa. And it has somehow created a bit of a negative perspective, as to say that as a country, we do not have the capability to make our own decision and to be to ensure that what is it that we really want to invest in, and what type of investments should we be able to attract, as decisions are basically foreign made from our side. I'm sure you guys that are based in South Africa, you will understand that. And that is really has been the most challenging aspect in the property market, as we are we are unable to transition to make independent decisions. And as to the hospitality assets, our hospitality assets are probably doing the best at the moment, as we are having a very high tourist numbers that are coming into the country. We also have a listed company that is also dealing with hospitality. A lot of lodges are popping up. However, there is a bit of an implication on policy issues as to how, in terms of how do we look at hospitality assets, whether we look at it from a business perspective, from a business as to regard it as a business, or create a new aspects as hospitality. But however, the market is very hot. A lot of foreign investment, especially from Europe, as they are really investing in the hospitality, and and then equally the Chinese market is appetite is really picking up, and a lot of Chinese companies are buying over the current hotspots in the hospitality, and that also creates a bit of a concern. And in terms of that, most of our hospitality now is very much foreign owned. But locally, we do not really have a very strong local economy in terms of investments in the property market. So it really give us a challenge as to how our market is being looked at, and what are the critical factors that we really need to start focusing and where to invest as a country. Yeah, as I said, we are really our market is very much in infancy in terms of growth. On the retail aspect, we've seen some also big investment coming from South Africa, and we have two listed property companies, which is rent to own, and the other one is Oryx Properties, basically operating in the listing space. However, they've been doing very well, but it's just that we are lacking serious data in the country as to be able to assess where the property market is really operating at, and at which optimum. In terms of the yields, as to what are the yields on a year-to-year on basis, I'll put it between an average of 9% to 11%. That is basically where I would put it. But yet again, with a heavy influence from South Africa, whatever happened that side, basically is similar what is happening in the country. Basically, yeah, from my side, I just wanted to give an overview of what is really happening in the country. But in terms of investment, there's huge investment potential. It's just that our local capital is very expensive, because it's regulated from a foreign base perspective. Yeah, I think that is basically all from my side. Yeah, over to you, Kura.
Thank you so much. Thank you so much. I've visited Windhoek, and I must admit it was a superbly organized and clean city. I mean, even your taxi ranks guys are putting stuff in the bin, and the bins are nice and tidy. I was most impressed with your public transport system, where you have a bus network with a description of the routes that it takes that look something quite like the London Underground through, I'm forgetting the name, it starts with a W, in the middle of town.
Okay.
Werner Hill or something like that?
Come again?
Is it Werner Hill in the middle of town?
Oh, yeah, yes, it's Werner Hill, yeah.
Yeah, good stuff, good stuff. So what is an average property price, and what sort of housing does the average urban Namibian look forward to, and what sort of prices are we talking about?
Yeah, the average price for the low income guys, in terms of now, that is not ultra low. It's which is basically built under the NGO schemes and social grants. We'll put it around about a 330,000, which is typically your RDP, typically the RDP in South Africa. When you then come to your middle to high income, basically you are sitting at a 1.2 million, a standalone stand on a very middle class suburb. That is running at 1.2, and our 2-bedroom units are running anything from 600,000 up to say 900 to $1 million for a 2-bedroom, also in a very slightly lower upmarket area. But as soon as you move to the upper market, you are looking at 1.6, 1.8 million rand in terms of average. But our average also basically differs. Basically, the two areas is the coastal area and the central area. That is where you have a consistency in terms of your average house prices. But when you move to the more rural area, that's the average price drop anything from 1.2 to an average of 700 in a single family stand.
No, I appreciate that. Okay, ladies and gentlemen, we've heard from all of our speakers here, and it's time for you, the audience. I think we've got 29 participants. Please, any questions from Leonita, Florence, Kundayi has left us, and Fransisco on the line. Can I take some questions? All right, my Q&A is...
Am I on the floor?
Yes,
Sorry, Kura,
you have
I
it.
don't know if I'm on the floor. I've just been unmuted.
Go for it, Tabo.
I will lower my hand. Wow, what an amazing session. I think I'll probably go to the Namibia sector, and mine is really around the case for Namibia, which to some extent I consider an extension of South Africa if you look at the west side moving north, and in many aspects very much like certain cities in South Africa. Now, in terms of things like vacancy levels across the different sectors, and maybe we can look at the retail sector, maybe a little bit of color around that one. And also when we look at the fundamentals around rental growth in relation to your inflation, is there an arbitrage there? I think Kundayi mentioned that we've now receded back to about 4.7 in South Africa. But roughly, where is your inflation and how does that relate to your rental growth? And then maybe the last one, if you don't mind, I was quite intrigued by the mentioning of 80% loan to values, if I heard you correctly there, and maybe just to get a bit of color around your debt service cover ratios being achieved on those type of loan to values, and perhaps would those be for 10-year amortization type structures versus your 5-year amortization structures? Because in many cases, South Africa, we are far away from the 80% levels. We are further down the hill at about 60, 65%. Thanks.
Kura, should I respond?
By all means, sir, by all means.
All right. Yeah, maybe to give you a bit of perspective, okay, the last time I was in South Africa was in March this year during the valuation conference, and I went to Sandton City. And basically what I'm seeing there in terms of vacancy rate is what is basically also happening back home in terms of in the retail sector. However, in the retail sector, your anchor tenants hardly basically move, and you tend to have a very high, a very low vacancy rate on your anchor tenants, and basically on your bigger brands like your Foschini, your Markhams, and all these other brands. They are performing very well. They have long leases and all that. What is basically struggling in the retail sector is the small and upcoming local entrepreneurs that are taking up the vacancy rate. And the best stats of the vacancy rates now, because we do have Oryx property, that is listed, and they also do publish their reports. And I think those are that is a very good, you could look at their reports, it will really give you good indicators. And they are performing very well, because on top of it, they also just purchased another shopping center at the coast for $500 million, they were also co-funded by a South African outfit on that aspect. Now, in terms of the rental growth in the retail sector, it is very strong, but in the residential sector, it's super, super strong. And that's why the government now is trying to start addressing the rental aspect through bringing in this new bill, the rent control bill, because there has been some activists around this, and it's really becoming unaffordable. However, the developers and the landlords are really cashing in, especially on the residential market. It's very, very high. On average, on a student average rental, and you're not even renting a single room, just like a bunk bed, it goes up to 3,500, and people are really cashing into this spaces. Maybe just to give you a perspective. And then what is also not driving the rental aspect in the slightly upper class is your oil magnet companies that are especially coming to Windhoek. And there's now a super high demand for upper class residential units, as this oil magnet, the oil discovery, is also creating a very, very its own dynamics in that space. And the high residential is extremely on demand, because obviously this is high skilled guys that are coming over, and on that class level, on top the residential. And also there's a lot of guys coming from West Africa looking for opportunity. So the residential market, especially on the upper middle class, it's extremely on demand. There's hardly anything in the market. It's basically who is offering the best prices. Now, the aspects of our inflation has been consistent. We are also running at around about 4.6. The last time I checked, I just didn't check the latest release. So it's relatively relatively stable, but as I said, it's just we do have an aspect of policy uncertainty, because our leadership is a bit not consistent in decision making. As today they are leaning to this side and all that, and that also creates a bit of a slow uptake on the development side. Now, on the debt cover ratio, basically what we have in the country is that this is purely more. We also have the same aspect as Kundayi was alluding to, the loan to value. This is more for individual, more on individual owning 3 to 4 properties. The idea is that the central bank have brought in this policy for that. For your first property, you don't have to pay any deposit. Second property, you have to put up, I think, 20-30%, and then you move to 30 or 40% on your third property. The idea is to basically slow down ownership, so that people don't, so that the rental market is not overexposed. And that is basically the monetary policy that the central bank has then brought in, and it's however, it also slows down the sales, because the sales market has really dropped because of that issue, as people now have to put up hefty deposit to own to own a number of properties, and a lot of investors have basically slowed down because on those aspects. So that is basically in a nutshell. I'm not so sure if I've answered all your questions, but all in all is that there is really a high appetite in terms of the rental market. That the market is there.
Are foreigners allowed to own freehold in Namibia?
Yes, you are allowed to own freehold. We also then, for the lower income bracket, we develop a concept of what we call flexible land tenure. Your flexible land tenure is basically you can demarcate a land portion within a local authority boundary, and your low income can settle in a structured manner, and they can group themselves and then start creating their own title deeds. Appoint all the relevant professionals, and until that they can eventually get to freehold. So so we have a right they were then issued of a right occupancy certificate that is issued by the local authority.
Thank you. Anybody, any questions from any of our panelists?
Maybe is the lady from Uganda, she's still on?
Yes, I am.
Okay, maybe because I'm also currently doing an urban land policy, and I just want to know on your ownership that I just want to know that it is not a must to have a title deed, and people prefer to have sales agreement.
It is that.
Do you register that sales agreement, or what do you do in that space?
The sales agreement can be registered. Actually, with the new changes, we have a registration services bureau where the sales agreement should be registered. Getting a title deed in Uganda is actually voluntary. It's with the advantages that come with the land title, where someone bases to say that I'll get a land title or not. And also what I heard from Namibia is that foreigners can get freehold. Ours, no. Foreigners, no. They'll not get freehold, they'll get leasehold titles.
Yeah, from our side, the foreigners not on residential. You cannot, you don't get residential, but you can get on commercial. And yeah, I think it's still a bit under discussion. But yeah, there is some instances where people got where foreigners could own land.
Okay. Ours is leasehold.
You learn something new every day. I didn't know Namibia had a separation like that. Uganda, I hadn't heard of major investments going in. Have they separated it just to be only residential exclusion or even commercial? I can't come in and do an industrial park there or do a data center. Would I have to partner with a local? How do we structure for that?
Yes, you'd have to partner with the local here in Uganda. You wouldn't do it by yourself. You'd have to partner with the local to be able to invest here.
50-50, 49-51?
49-51.
In my favor.
No, in the favor of the Ugandan.
But we are Pamodzi, we are one people.
Yes, we are one people, but we want our Uganda still to stay Uganda, because they're looking at a future where if they let maybe foreigners, actually that is the argument, if they have so many of the foreigners allowed to own land, we may find the indigenous Ugandans getting lost in there.
Well, we've had Botswana on the line before, and they went with a 30% transfer duty when a foreigner was doing a sale. I think they've reduced that now, so I'm not sure that that policy has succeeded. Leonita, from Zimbabwe side, we did have indigenization stories, but beyond that, are there any preclusions of foreigners owning real estate in Zimbabwe? All right, I think she might have dropped off the call.
I think she's still around, but I think the host will have to give her access to talk. While we're still waiting for Leonita, I think Dr. Chowa is having something to ask, if the host can also allow him to talk.
Thank you. Quite insightful discussion. I'm based in Zambia, and I hear perspective, hear my Zambia comparisons. But from what I saw, there's been a lot of activity in Zambia, and we have seen very interesting developments, especially in Lusaka. And my question is basically to hear from the panelists whether there is any consideration of Zambia as a market, and what are your insights about the kind of market that we are in. Thank you.
Thanks for the question. Anybody thinking cross-border? From my exposure in the Zambian market, you do have some South African interest. Lango, I believe, is significantly in Manda Hill, amongst others. The Chinese have their own sector and space. I see them in the tourism and hospitality, building hotels and casinos. I know Terrace Africa did Waterfall Mall, I believe, in Lusaka. So I think there's fluidity and interest. In discussing matters with a Botswana client, they expressed interest in Zambia, where they had said, Zambia is Africa light. So it is outside of the Rand monetary area, but the business conditions, the Roman Dutch law, the nature of tenants and leases, and the action to recover money if people are not paying rent were reasonable and familiar, and there continues to be appetite for those assets and investments. I think there was a bit of a wobble when the currency, when access to hard currency became a bit of an issue, but this is the nature of doing business on the African continent. You got to take a long-term view and have appropriate finance. Borrowing in dollars to invest in softer currency markets, and when legislation can change on you, where you previously had dollar leases, now you have to do kwacha leases, that has some sort of implications on the covenants. All right. I'm going to.
Am I clear now?
Yes, go ahead.
I'm getting feedback. Just to answer the question on foreigners being able to purchase properties in Zimbabwe. Yes, they can buy properties in Zimbabwe. There is no limit. According to the Constitution, everyone has a right to own property. So either they can set up an investment portfolio, open a company, buy the properties and put them under the company, or they can directly own the properties. So we don't have so many restrictions. The indigenization bill, it was there, it was 4951, but at the moment, foreigners can actually own 100% of their property.
Thank you very, very much for that.
Oh.
All right. I don't know if anybody else has got some parting comments or questions. Sorry for the technical difficulties right at the start of the webinar. Technology is going to do that to us sometimes, but I'm grateful to have found signal, and with your patience and for the moderator picking up and working through. Thank you to my African panelists for keeping us informed and taking us around the continent. We hope to do more business with one another, We now have names and contacts that we can actually reach out when we come across on the continent. I thank you all for your ever-growing attendance and attention. And please feel free to message any of the panelists or the ACRE team, Academy for Construction and Real Estate, to put these things together. From me, Kura Chihota, as your moderator, thank you so much for your time and attention. And we look forward to coming back to you next month, where we will do another one, the pulse of the commercial real estate market across the African continent. To my panelists, thank you so much. But for you who've attended and made us put in the work, we're most grateful. Thank you so, so much. Have a pleasant evening further. God bless Africa.
Thank you, Kura. Thank you.
Thank you, Kura.
Thank you.
Thank you.
Thank you.